participants in this morning. So welcome everybody to essentially, I suppose, our follow-on webinar from the webinar we did this time last year on the whole area of FRS 102. And also, I suppose, essentially a follow-on on the numerous webinars and seminars we've been having over the last number of months in the whole space of CSRD, ESG, and all things sustainability. So welcome to everyone. And we'll try and make the session as practical as we possibly can, and hopefully get some good nuggets as to where things are at from a corporate reporting perspective at this kind of point in time. So before I get into the detail of the agenda and what we're going to cover, I just want firstly to introduce you to my colleagues on the call. So for those of you who don't know me, my name is Brian Murphy. I'm a partner in Audit and Assurance. I'm joined by John Kelly from our Cork office, also a partner in Audit and Assurance. And then also joined by Claire Ryan, Managing Director in Audit and Assurance, Gareth Martin, who's a Managing Director in our Assurance team in ESG, and also Dimpna Cassidy, a Director in our Accounting Reporting Advisory Services. So welcome to all of our panelists, and we look forward to talking to the guys over the next 80, 90 minutes around all things corporate reporting and the updates that you can look forward to looking at in your accounts over the next kind of number of months. So from an agenda perspective, what we're going to kind of cover off, we're going to kick things off with ESG CSRD, and we're going to have a discussion with Gareth Martin in this regard. Significant changes and updates in this regard. So looking forward to imparting all of Gareth's knowledge in that particular space so that from a private company perspective, you kind of understand where things are at this point in time, what reporting obligations there are, and what we're seeing in the market and around private companies and what they're doing in that particular space. We're then going to move on then to the core, really, I suppose, of today's session, which is around FRED 82, or essentially the updates in FRS 102. And Dimpna is going to give us again a broad overview of those particular changes. And we're going to then focus into two very core specific areas where it's quite an element of change, which is revenue and leases. And both Claire and John are going to bring us through those. Dimpna then will close out that session to give us just, I suppose, an indication of other kind of changes and insights. And that will be followed then by Q&A then to the panel. So please, if you do have any questions, put them into the Q&A box or into the chat box, and we will do our best to try and cover off all those questions at the end of the session as well. So hopefully that's clear, and you'll get kind of something from the session. Before we kick things off, we just have one kind of, I suppose, overriding question for everybody, and that's the first poll question. So we will just get you to participate on 4 or 5 occasions during the session. And that is, firstly, how ready are you for the up and coming changes in FRED 82? So are you yes, all set? Have you made great progress? We've started but made, I suppose, some progress and not ready at all. So if you could just answer that poll question, just give us a sense of where things are at, and we'll be able to then kick the session off. So we'll give you 30 seconds to complete that. Okay, do we have a sense then of where that's landed? Okay, so we've 62% of people not ready at all. So that's probably a good thing you're here so today. 28% started, but some challenge. So again, hopefully from today's session, you'll garner some further thoughts. And we've 3% all set. So potentially you might join us on the panel if some people have some suggestions or some ideas of what you've done so far to date and what's made that work. So thank you very much for that. So that gives a good sense of where things are at. So as we said, going to kick things off then with Gareth. So Gareth, you might just bring us up to speed in regarding what's happened in the whole, I suppose, ESG CSRD space. Where are we at now? I think a lot of material, a lot of media attention. But maybe if you could sum up for us, what's the current landscape?
Sure thing, Brian. Thank you. So I think in terms of what's happened, recently we've had the omnibus proposal come out on the 26th of February, which is part of a wider programme of simplification at an EU level to remove regulatory burden. So that encapsulates sustainability, all aspects of it, but it's part of a wider program as well. But sustainability was one of the first packages that came out. So it's wide ranging. You can see on this slide there's quite a number of key changes that are proposed to the existing legislation. So it's not just the Corporate Sustainability Reporting Directive, CSRD, it also impacts some of the other regulations as well. But I suppose the headline really to start with is around the stop the clock proposal. And you can see that at the top left. It's a 2-year delay to wave two and wave three companies reporting under CSRD that were due to report for year end 25 and 26. They now have a 2-year delay under this proposal. So in order to make that happen, this has been split out separately from the rest of the proposals to fast track it, and it's actually subject to a vote at European level today to move forward to be able to get a piece of legislation published at a European level so that then can be transposed locally. Because the risk is that if that doesn't happen by the end of this year, then the legislation as it currently stands is applicable, and all companies that are currently in scope will remain in scope. So there's a lot of support to make that happen at a European level. And then also locally, the minister came out this week with a statement to say that they're very focused on making sure that once that piece of legislation is published at a European level, it'll get transposed locally to ensure that that's enacted. So, like, I think at this stage, the risk is pretty low that that's not going to happen by the end of this year. So that's really important to give certainty to all the companies on this call and more widely.
Yeah.
The other proposal then as part of that are continue to be subject to negotiation. So they will take a bit longer to come through, to be finalised and to be ready for transition, and are more likely to change as well, because there's definitely views across Europe as to the proposal not going far enough or going too far. So, anything that's on the page is that you can see at the minute is subject to change. But in terms of where it stands at the minute, what's proposed, thresholds is a key from a CSRD perspective. So the thresholds will raise to CSRD only applying now to companies with over 1,000 employees and either 50 million turnover or 25 million balance sheet. So that should remove about 80% of companies that were in scope, and simplify the regime significantly. So that's a big one for companies, particularly in the private space. For those companies that do remain in scope, there's a review of the ESRSs that underlie CSRD to occur in the next 6 months, with the focus of that to be reducing the number of data points that are in scope and to be more quantitative in focus.
And Garrett, just on that one, because I know we have got a number of queries on this. So the 1,000 employees at the key point. So some people have misread that it's still the 50 million turnover, et cetera, et cetera. It's and all of that. So companies that originally were in scope because of revenue in its own right, that's completely scrapped in terms of the new wording and around it. So your starting point now is employee numbers and working backwards.
Exactly. So 1,000 employees plus and either 50 million turnover or 25 million balance sheet. So there's a reduction in the number of data points. CSRD will remain a limited assurance framework as well. The proposal to move it to reasonable assurance has been taken away. And then other than that, EU taxonomy is again being simplified. The thresholds are being raised to 1,000 employees and 450 million turnover. And the Corporate Sustainability Due Diligence Directive, CSDDD, is also subject to a 1-year delay and has been somewhat simplified as well, in terms of you only have to consider direct business partners as opposed to your full value chain. So that's the proposals at a high level for you, Brian.
Yeah, and thanks for that, Gareth. So I think that does kind of really clarify the majority of private companies. The reality is that now CSRD is not going to be applicable from a reporting perspective. I think that said, Garrett, I mean, we are certainly still having conversations with clients who, there were elements of CSRD and what needed to be reported that there was interest in. There was certainly, I suppose, topics and areas within the standard that did make sense for companies to consider. So would you just give us maybe a flavour of what it is you are seeing companies doing? So while they mightn't necessarily need to report under CSRD, I would still believe sustainability, ESG, it's still to the forefront of companies, and just maybe give us a sense of what you're seeing companies doing, I suppose, in this space then.
Sure. Yeah, we're continuing to have a lot of discussions with companies right across a range of sectors and a range of sizes. And I think, sustainability as a focus or an issue for business hasn't gone away, regardless of what happens with CSRD and the regime around reporting. Sustainability is here to stay. It's a focus at government level, at policy level, and will therefore continue to have impacts for business. So, as with any other sort of macro or market factors, even looking at the trade tariffs that have come in from the US in the last day or so, sustainability remains on the agenda for companies. There's still a need to consider, what's important for them. So there's that opportunity to pivot away from, this mandatory requirement around reporting that's taken up a lot of capacity and a lot of focus for companies to be able to say this. These are the things that we really need to focus on from a sustainability perspective. That's going to aid the business, and either manage a risk or take advantage of an opportunity. And that can be around things like energy efficiency, the product range, the employee value proposition from a social perspective, or other regulation. So we've got a slide. If we move on to the next slide, just setting out some things that companies can consider doing around that. Some no regrets actions that are going to benefit the company. And these are things that we're discussing with a number of different companies, and we're active in that area. So if we can just move on to the next slide, please, Rebecca, we can run through those. Thanks very much. I'll not go through them, in lots of detail, but a key action that companies are still focused on is around strategy. So whether you've done your double materiality assessment already as part of an implementation or now out of scope, or whether you haven't done it, like thinking about what are the impacts on the business from a sustainability perspective, what are those risks and opportunities. The double materiality assessment, if you have done it, still has lots of value to the business from a strategic perspective. But if it hasn't been done, peer analysis can be done on 2024 reporters in your industry or similar size, or you can perform your own internal exercise or get some support to do that. It doesn't have to follow the DMA framework that's set out in CSRD, but just being able to consider stakeholder views, consider views within the business to understand what are the risks and opportunities for the business, and then bring those onto the corporate agenda to be able to address those and take advantage of them.
Great. Yeah, thanks for that, Gareth. And I think, maybe one word you've said there, opportunities, is something to kind of be considering. I suppose the general gist of this originally, maybe some kind of negativity and, maybe, I suppose, challenges and issues, but actually there was lots of, I think, opportunities we found when we did talk to companies in a little bit more detail around this. So I certainly think and believe a number of them are still there. And Gareth, you and the team are still very much available to talk through with companies if this is an area that they want to still have a looking around, be it they mightn't necessarily have to go down the substantial reporting and around it, but certainly there's still things here to see.
Yeah, absolutely. We're continuing to speak to companies and understand, what's important to them, what are their next steps, and be able to advise in that space. So, we're very happy to have conversations with anybody on the call just to think about what the next steps are and particularly, what might be a particular focus for your industry.
Great. Gareth, thanks a million for that. That's great. Great
Thanks,
to have
man.
a full update around that. So if there are any particular questions on that particular area, if you want to put your questions, as we said, into the chat box or the Q&A, Gareth can address those towards the end of the session. We're going to now move on to FRS 102, or FRED 82, I suppose, as it has also been referenced to. And Dimpney, you're just going to take us through, I suppose, some of the specifics and around adoption, and some of the kind of high level comments if you want to take us through those.
Yeah, great. Thank you so much, Brian. So I suppose maybe to start off, there has been quite a lot of changes for FRS 102. So recently we have had Pillar 2, there's been some amendments there. We've also had effective 1 January 2025, the supplier financing, additional disclosures that are needed as well. But by far the most significant changes since FRS 102 has been effective is FRED 82. And in particular, as you've mentioned, Brian, the points around revenue and leases, which I know Claire and John are going to get into much more detail on, are really, I suppose, the kind of bright lines for where entities should expect to see the most significant changes. You are permitted to early adopt FRED 82, but you are not allowed to cherry pick. So if you do that early adoption, you have to take everything all at once. And just also to note that originally when FRED 82 was issued, the effective date was 1 January 2025. That was pushed out to 1 January 2026, which is, I suppose, wonderful for to give people a little bit of extra time just to catch up and get through all of the guidance.
And
Um,
dipped on that as well, maybe to make sure everyone's clear it's not changing again, right? So I have had some people hoping, like with CSRD, will move it 2 years. Like this is not moving. It's definite January 26th.
Yeah, sadly, I think this
Yeah,
is there's
it's
a line
here.
in the sand on this one. Yeah.
Yeah, yeah, okay.
But just to mention as well, because it's a really good point, Brian. So between the exposure draft and the final version of FRED 82, there has actually been changes as well. So just to make people aware that if you are looking at documents or kind of support guidance, just make sure that it's based on the final version. So there was a number of practical expedients and simplifications that were in the original exposure draft, which just didn't make it through to the final edition. So yeah, a really good point. Um, the changes really are quite significant, but I don't personally find them that surprising. If we look at the fact that FRS 102 is supposed to be a simplified version of IFRS, for it to keep relevant and to kind of keep up to date with all of those significant changes from an IFRS perspective, this overhaul really is quite needed. So if we think from an IFRS perspective, we've had the new financial instrument standard, the new revenue standard, the new leasing standard, the new insurance standard, and it doesn't stop there. We've got two more IFRS accounting standards, which will be effective 1 January 2027. So that's the change for presentation of the financial statements, IFRS 18, and also a really interesting standard from an IFRS perspective, IFRS 19, which is a reduced disclosure standard for subsidiaries without public accountability. So there's really huge amounts of changes going on from an IFRS perspective. So this is really just, I suppose, creating more alignment, in particular on revenue and leases, and making it easier, in particular, for those who sit within IFRS groups, hopefully resulting in less consolidation adjustments when you're trying to do your ultimate consolidated financial statements. I will just mention as well, just for those who are affected by FRS 105, the changes are not exclusive for FRS 102. So if you do have micro entities, FRS 105 is also being updated. However, the lease amendments are not impacting micro entities. It's predominantly the revenue changes. And again, to accommodate the fact that micro entities should have a more straightforward framework, there's additional simplifications even from the FRS 102 changes for revenue that will be applicable for micro entities. So a really nice piece around that is the fact that micro entities can transition to the revenue requirements on a prospective basis, which definitely simplifies the process. So if we just Great, thank you. Pop on to the next slide. So just the key point I want to make here is that there is a number of versions of FRS 102, and just be sure that you are using the correct one. So the September 2024 version, and the link is included here on the slide, is the version that you should be using if you've either already adopted FRED 82 or when you come into the FRED 82 era, which is 1 January 2026 onwards. And then as well, just also the link for FRS 105. Again, this is the September 2024 version, so just make sure that you are using the correct versions of the standard. So I will just give a very brief overview. There is a lot of changes. Again, as we've mentioned, leases and revenue being the most significant changes. There is some edits specific for UK companies in relation to Section 1A as well, which we'll get into a bit of detail on later on in the session. We are seeing changes coming in from Section 2, which is being amended by the ISB's conceptual framework for financial reporting. So that's quite interesting. And something that's great to see as well is some additional guidance from IFRS 13 coming into the fair value measurement guidance, and also the fair value measurement guidance getting that bit more prominence by being moved from the appendices of the standards right up into the main part of the framework and being included in that section 2A. There's a number of other incremental improvements and clarifications, and sadly we couldn't fit them all on the slide. However, you can get the full comprehensive listing in the standard, and we would recommend that you do that comprehensive review. Just, I suppose, to highlight that this isn't just an accounting change. So you do have to think more wider than just what is the impact on my financial statements? What is the impact on my disclosures? There is also questions and documentation that you need to think about from your external auditors. What is it that they expect you to do? How impacted is your business? Equally, from a valuation perspective, we are seeing some changes, for example, in share-based payments, which could mean that you might need to have a look at how are you doing that on a go-forward basis. And equally, whenever there are any changes of this nature, things like your internal controls should always be considered. But equally, quite interesting, and I know John will go into more detail on this around key performance indicators, for example, EBITDA. There is some changes that's happening there as a result of leases in particular. So you do have to think, I suppose, of the wider impact, and there is definitely an element of stakeholder management needed with Fred 82.
Yeah, and I think on that, I think the two key areas. I mean, we're certainly seeing a lot of questions coming from, whether it's kind of equity-backed businesses, whether it's kind of companies with a lot of debt, where the financial institutions need to be talked through the changes that are going to be made if you have significant right of use assets now as a result of the kind of new lease requirements. So that's really important. And I think the second area we're seeing practically is on revenue. When you do your kind of your step through on that, you know for some businesses, there's some nuances kind of falling out of that. And again, that's something that we're finding we're needing to support in terms of explaining that to various different stakeholders as well. So they're probably the two kind of key areas to watch out for. Okay, thanks for that, Dimpina. We're going to just move on. We're going to just ask you another question just to kind of drive the next kind of section of the course. So we're looking in terms of what are your main areas that you find the most challenging. Um, Again, 30 seconds. Is it non-revenue leases or other? So you might just give us a sense of that. We may be able to talk through that then in the Q&A. You have a result. Okay, quite even actually. So no major challenges, revenue and leases, and then also other in terms of stakeholders. So practically actually across all four. Okay, thanks for that. That's also kind of useful for us. So we're going to move on now to the two, I suppose, what we see is the very clear specific areas that we see and that we're working through with clients, which is around revenue and leases. And I suppose for both of those, John and Claire are using, I suppose, a profile of a company to talk you through and to show you some kind of practical examples. So the kind of profile of the company that we've kind of taken that we hope, kind of broadly speaking, will kind of cover the actions and the kind of, I suppose, walkthroughs of each of the different areas is company A here. It's an Irish incorporated entity. It has a UK wholly owned subsidiary. Its functional and its presentation currency is in euro. Primary business is the selling of goods and support services to third-party customers. Company A manufactures printers and provides printer support services, and it uses a subcontractor to deliver those printers to French customers. And it's currently applying FRS 102. So using that kind of backdrop, now Claire is going to start us off first to look at kind of revenue and the potential kind of challenges and kind of changes that this particular company will need to take. So Claire, if you want to take us through revenue, thanks.
Thanks, Brian. Yeah, so I'm going to kind of talk through some of the kind of key differences and the steps that you kind of need to follow through revenue. I suppose I kind of back to kind of what we said earlier, the impacts will vary from different industries, different revenue streams. But I suppose the kind of the key thing to maybe take away from this is really around looking at it and really going through the steps and stepping back. So sometimes I know when you have kind of an old standard and you have a way of recognizing revenue, sometimes it can be hard to kind of step back independently and go through those steps that are now part of the standard to really see, are they all applicable still to your entity? Is there going to be changes to the way you recognize revenue? So I think if we just pop on to the next slide, just in general, I suppose when you kind of look at the standard itself, it probably is a bit more prescriptive. I think a key area that probably really focuses on is that word of control. and who has control of those goods and services, which kind of links into some kind of small changes with regards to kind of agent versus principal, and I suppose how we look at that with the new standard compared to the last standard. And the big change, which I know has been mentioned a few times, is really around that 5-step model. So really kind of aligning back to IFRS, which has a very kind of similar 5-step approach to how you recognise revenue. And I suppose on the slide there, you'll obviously see the 5 key steps. And as Brian said, we kind of use that example there that we kind of brought forward earlier to really kind of step through those, to just try and bring a bit of practical element to what they actually mean, and how you can actually see maybe from your own perspective of how it might apply to you. So ideally, obviously, firstly, you're identifying the contract, which is actually very clear in the standard about what makes a contract. Then you're going to look at that contract and go, what are my performance obligations? You're going to look at how much is that going to be? So what is the price that you're going to get for those? And then you're going to allocate those to your individual performance obligations you've identified. And finally, recognise that revenue when you're happy that that has been satisfied. But as I said, over the next few slides, we'll talk through those in a bit more detail. And I'll definitely use the example to just kind of highlight the key points that come from those. So said the first one is to identify those contracts. So I suppose if you're starting the journey, this is where you're going to start day one. And I suppose it is really to kind of step back, look at the revenue streams you have, and to kind of consider the 5 key points that they highlight here. So ideally, I suppose what they're saying is if you are meeting these 5 things, you have that contract in place, and then you can kind of move forward to the next steps. So I think when you kind of look at the 5 points, they are quite logical. So it is really around that. There is that approved contract in place. There is a commitment. You've got payment terms. Everyone is kind of aware of what their rights are with regards to the goods and the services. It's a commercial transaction, and that ultimately the customer will be able to pay when it all falls due. So they're quite kind of simple, but I think it's to kind of highlight that, as I said, to maybe not use the bias of how you recognize your revenue before, and to step back and go, are those 5 things actually in place? So that you can get to that place of, right, we have our contracts, so we can now move on to kind of the next steps. So kind of just to bring in the example that kind of Brian had introduced. So we have the company, they have a new customer, they're going to sell goods and services for 120k to them. They have that signed agreement in place. It's been negotiated. It's at arm's length. They've done their credit check, so they know that these customers are going to be able to pay when it falls due. So when you look at that, and I know it might seem in a very simplified version, but you can clearly see that we've met the 5 criteria. So you're comfortable that this is now a contract. And I think just to kind of bring in a piece from the audit perspective is when you're kind of doing this journey, this is obviously going to be a key focus from auditors when they're looking at it. So kind of how you got to this conclusion and having that documented will kind of become important when you kind of start the audit process. So, you know, some scenarios, this will be obviously very, very clear, depending on the revenue streams, but definitely if you have maybe more kind of variety in your revenue or a few nuances, you know, documenting how you got comfortable that it did meet these 5 criteria is going to be important for you going forward. So the second part then, once you have your contract, is to identify the performance obligations, which is really around the goods and services that you're kind of promising in a contract to a customer. And I suppose the key wording that kind of comes through the standard is that distinct piece. So you're going to be really categorizing them into, I have distinct goods and services, or you may have a bundle of distinct goods and services. So when you get to this step, it really is focusing on that distinct element. So really what we mean by distinct is that the customer basically has and can benefit from those goods and services either on their own or with other resources that they might have to be able to deliver it to a client, and that it is separate from other promises in the contract. So therefore being really distinct. So if we go back to our example that we just had, you'll see, just on the next slide, you'll see that when we come to the example, you've basically got 2 elements here. So we have our company. They're selling their printers, but they can also offer the support services for those printers. And the support services are available in the market from competitors. You can buy a printer and not have support services. But when you're coming to that piece of where is my performance obligation, so when you look at this from a kind of a simplified perspective, it's very clear and distinct that the sale of printers is a kind of one performance obligation, and your second one is those provision of support services. So depending on obviously the different revenue streams you have and the complexity of it, but it is really to focus in on that distinct, and you should be able to then really kind of separate out your performance obligations in that distinct nature, and also consider, some might be very similar performance obligations as well. Step three, I suppose, in one way, I suppose, when we all kind of come to revenue, we kind of consider the transaction price should be quite straightforward in the sense of what are we going to get? So what consideration are we going to get to provide these goods and services, kind of excluding any amounts you might get on behalf of the third parties. So it is essentially that. There is kind of some things to consider, which we will look at over the next couple of slides. But just to go back to our example, just to kind of bring forward that transactional price piece. You'll see here in our example, we're saying they've got a contract, they're going to sell 10 printers at 10K, and there's also 20K for a year of support services. And the customers will also get, if they're a new customer, a 5% discount. So I suppose when you're looking at the transactional price, as I said, it is that 100K less your discount price, which is obviously for the sale of the printers. And then from a service perspective, it's the 20K is obviously going to be your transactional price for those services for 1 year. So just to kind of consider a few pieces, as I said, around that kind of selling price piece, which, as I said, in a lot of instances will be kind of straightforward. But I suppose it is to think sometimes you will have more than one performance obligation, and some of those will happen at different points in time. So it is just to kind of consider, as I said, in a lot of instances, you might have your standalone selling price, you have your performance obligation, it's quite straightforward. But I think just when you have some discounts or you have some variable considerations, to kind of stand back there and make sure you're comfortable that the actual transaction price you're allocating is correct. So for example, in that you have a discount, so you do need to consider, are you applying that discount to all your performance obligations in the contract, or is there actually, it only needs to be applied to certain elements of the performance obligation? So I think it's just one to watch where, as I said, if you have that revenue where you have a bit of a variability to it, that you are really considering how you're applying those to your performance obligations. So back to our printer example here, as we said, we have the printers. They're selling for 10K per unit. You have your support services, which is 20K per unit. And we've also mentioned that they would have a discount. So back to that piece of, if we're applying that discount now, does it need to apply to all your performance obligations, or where does that lie? And obviously that is very specific to people buying actual printers. So you'll see in the calculation there that actually you're obviously applying that discount rate only to your printers and to not your support services, which will stay the same. So that's just to kind of very kind of simply show you that allocation of the price and kind of a variability of discount to your different performance obligations. And finally, I suppose when you get through all those steps, you'll get to that point where you're obviously going to be looking at recognizing revenue. And essentially that obviously is when you satisfy that performance obligation with the transfer of goods and services. And I suppose the key wording here really being control. So, when does the customer actually obtain the control of the good or service? And I think slight change in the sense of we would have always been very much more focused on risk and rewards when we're talking about the old standard. That was kind of where we all went to when we were talking about revenue and revenue recognition. But just to kind of note, it is really around that control. And essentially, I suppose, depending again on the different revenue streams you have, that could be recognizing at a point in time, or similarly, you might have it over time where you have kind of a service that might be over a year. And this is just kind of one probably just nuance. I said it might not be for every company, but just in that piece of where you have very similar and consistent performance obligations, to just make sure you're considering what method you're using for measuring that progress of meeting your performance obligation to recognise your revenue. So, and I suppose the key point there is, if you have very similar performance obligations, okay, what we would expect to see is that you're applying a very similar method to those. So they talk about input and output method, but just for an example of, if you have something that you're recognizing based on time elapsed, or how much costs have been incurred, or how many labor costs have been incurred, whereas you might have something that's very much more, well, actually, we've got our survey, it's fully completed, we're recognizing the revenue now. So if you have different performance obligations where you might have different types of contracts, etc., it's just to make sure that you are looking at that and going, well, actually, these are very similar performance obligations, so we shouldn't be using loads of different methods to recognize that revenue and that performance obligation. So it's just more for those that have that kind of variable element and maybe more contract based and more complex revenue elements, to just make sure when you stand back and you look at it, that it does actually apply consistently across those that are similar.
Yeah, I think on that, we're seeing that particularly in kind of engineering businesses, where kind of going back to kind of the contract and understanding kind of what the model was previously. is really important to make sure that now it's validated correctly then when you're kind of applying this model.
Yeah, and I think that is a good point. I think it's back to that point earlier. As I said, sometimes we look at those contracts and go, sure, we know it. This is what it is.
Yeah.
This is the way it's always been. But as you said, when you look through some of those points, there might just be slight nuances that do change the way that we recognize it going forward. And this is a very straightforward example just to kind of highlight that piece of, as we said, we have our printers, a customer is going to pick them up or get delivered it. And that's obviously a point of time, whereas your support services are going to be obviously through the year. This is just kind of a very small point, but I know it might be applicable to companies on the call with regards to kind of that principal versus agent. And while it's not that there's a whole change in the way you recognise it, it is really back to that piece of what we would always kind of use in terminology to determine what a principal versus an agent is. And this is really back to that control piece. And as I said, a lot of our kind of terminology and the way we would have always looked at it in the past is very much risk and rewards based. And they have included kind of 3 indicators of this. And I suppose in the previous standard, risk and rewards would have been a specific indicator highlighted there. But as you can see, it's actually been fully removed now. So there isn't that kind of talk of risk and rewards. So it really is around who has the responsibility to fulfill the promise of the goods and services, who's holding that inventory risk before it's transferred, and kind of who ultimately is the person that is establishing the pricing. So while it might necessarily lead to fundamental change in revenue recognitions, it is just, again, for those nuances where you are kind of stepping back and looking at it and going, what is our control here? And these 3 indicators, does it actually meet those now? Because again, it might just be slight changes because, as I said, that risk and reward piece is kind of, and the wording is ultimately removed now from the standard. So in certain instances, that could be slightly different from where you have control. So I think that is an important one. And I know, an example we were talking about yesterday was really around sometimes if you have goods and obviously if a fire happens or they get destroyed, we would always talk about who's got the risk and rewards. And sometimes companies might say, well, actually we've insurance in place, so actually this is never going to impact us. But I suppose under this you have control of those goods, whether you have insurance or not. So therefore you are obviously going to have to look at it from a revenue recognition perspective. So this is very simple, I suppose, when you get to the end of your 5 steps and you're looking to go, what do I need to recognize now? So some companies, as I said, ultimately, maybe when you walk through all those steps, there isn't any changes to your revenue recognition. But for those that there is an adjustment to your revenue, there is 2 options. So there is one for fully retrospective, which I think we can see that very few people are really probably going to take that option in reality. And your second option is to retrospectively basically include an adjustment into your equity when your kind of date of application comes about. So as I said, we will largely see, obviously, most people will be taking that option too. So this slide here, it just kind of highlights some practical expedience, which I know Dimpna has kind of mentioned as well earlier on. And I suppose, again, it's kind of a key thing to just understand from your business perspective, do these apply to you? So that when you're approaching this from the start, you are actually aware of these so that you're not going off and going doing a lot of extra work and then realizing that there was these expedients here that might actually apply to you. So just to pick out kind of 1 or 2 of them really in particular, if you have those completed contracts, you don't necessarily need to restate them if during that period they actually begin and end in that reporting period, or that the completed contracts are actually completed before the earliest period you're presenting. And then the other one I probably just would highlight as well is around, again, that contract piece. So if you have completed contracts that have variable consideration, you can use the transaction price of the contract at the date it was completed, if again it was obviously completed during that period, instead of having to do kind of estimations about variable considerations, etc. So I think that just highlight those 2 in particular. And I think back to Brian's point, a lot of this is really around those contracts elements. And I suppose if you have them in your business, to definitely kind of look at those practical expedients in particular, because they may be relevant for you. The last piece I'll just kind of highlight, and I know it kind of touched on it, but I suppose obviously the companies are working through these, but from an audit perspective, it's obviously going to be a very key area for us as we hit those audits when it applies. Revenue in general is always a very significant risk area. It's probably where we spend a lot of our time as auditors. And I suppose, as I said earlier, the assessment that you guys are going to complete, it's really making sure that you're engaging early with your auditors and you're including them in the discussions so that anything that kind of comes through, you can have that discussion about, and I suppose both end up in the same place, sooner rather than later. And I suppose we're kind of seeing that a lot of people are really trying to do this, I suppose, in the interims, and really kind of get that assessment done with the clients understand it, and then ultimately be able to kind of close it off before year end, so that when you come to your final audit and if you're under pressure, timelines, etc., it's kind of all been done and dusted, and it's not going to rear its head, I suppose, close to a closing meeting or an audit committee, etc., signing of the accounts. The other piece I probably mentioned earlier as well was around the documentation of it. So in particular, I suppose those that might have maybe not so straightforward revenue or a few nuances or variables, it is going to be really important to document how you went through those steps, but also how you concluded on each of those steps, that's the solution that you got to. So any of the judgments, which we talked about, especially as I said, around kind of any of those variable elements, it's going to be very important to have how you documented how you got there and how you got your conclusions. And you are essentially running them past the auditors sooner rather than later to make sure. So I think, again, a lot of audit stuff, it really is around that engaging early and having that discussions, as I said, as part of your interims, so that come your final, it is kind of all done and dusted.
Thanks, Claire. And I think, I mean, the final point just on revenue, I think, which we're experiencing a bit with clients at the moment, is, step one is very much you're identifying a contract, which sounds like a very simple thing, as you kind of referenced. But actually, when we go to find contracts, actually, clients are actually using this almost as a kind of a tidy up, maybe, of how things are done internally, because actually we're finding contracts are missed, contracts are not signed, contracts are half signed, there's bits of contracts kind of pushed together. So like that is your starting point. So you may need to use this as a bit of a cleanup exercise as well in your organization to have all that in place, because that's going to be the starting point also from an audit perspective. And if that isn't in place, or if things are not signed, or if things are completely out of date, now is the time to kind of try and rectify that. And then I suppose all the other steps kind of then follow through from there. Okay, Claire, thanks for that. So I think we've another kind of poll question just to kind of to get a sense of people's thoughts. I'm nearly afraid to ask this question, but we'll ask it. Do you see any benefits for your business from the standard? We can feed this back to the regulators. Probably afraid to get the answers. They're coming through. %55% no, 24% maybe, and 21% yes. Not actually what I was expecting. So good to see. Okay, we're going to move now on to John. And John, again, using the kind of the same kind of background and company, is going to talk us through leases and bring you through some kind of practical examples of some of the considerations there. So over to you, John.
Thanks, Brian. So I'm going to talk through the new leasing standard, and I'll start with the key differences. So FRS 102, as Dinta said, is aligning with the IFRS leasing standard, IFRS 16, but it's not an exact carbon copy, and there are some things that make it a small bit easier than a transition to IFRS 16. So what are the main changes? There's a single model for lessees. So this model is bringing what were formerly operating leases on balance sheet. And how do they do that? That's in the form of right of use assets and lease liabilities. So the assets relating to operating leases will now effectively be brought on balance sheet. And there's a control model for the identification of the leases, and there are steps that you have to walk through to identify whether a contract includes a lease or not. And this isn't always straightforward, and I'll give a couple of examples of that. And one new item that's specific to FRED 82 and new FRS 102, and it's not included in IFRS 16, is the option to use the observable borrowing rate. And this is a real positive option under FRED 82, which should make life a lot easier on a transition to the new leasing standard under FRS 102 than it would be transitioning into IFRS 16. So this graph is the control model for identifying your leases, and I'm specifically going to focus on the first three questions because I think they really hit the main points. And this is what you'll have to do with your contracts that possibly or do include leases. So the first question, is there an identified asset? So this can be very straightforward. And you have a building, company A has a building, they rent it, they have it for 20 years, they pay X amount a year, and the building is theirs to do what they want with it. That's pretty straightforward. In that case, you have a lease. But if you had a retailer who was hiring a retail space, and the landlord, there's a clause in the contract where the landlord can decide what unit the tenant uses. So the landlord could effectively take you from the really prominent area in the retail center and move you to the fifth floor out the back. In that case, there's no identified asset because it can move. And in that case, then there isn't a lease, and that is a service contract. So it doesn't fall under the new leasing standard. And the next two questions are kind of linked. So does the customer have a right to obtain substantially all of the economic benefits from the use of the asset? And who directs how and for what purpose the asset is used throughout the period? And for these first two questions, I'll give the example of a supplier who provides a truck to transport goods for a customer. So if the customer is the only user of the truck, then the customer is getting all the economic benefits of the truck and there is a lease. However, if the contract included a clause that allowed the supplier of the truck to use it when it isn't in use by the customer, so they were taking it for all of the weekends, and that time was substantial, then the customer isn't getting substantially all of the economic benefits of the truck, and in this case, there wouldn't be a lease. Likewise, if the supplier of the truck decides how the truck is to be driven, who the driver is, what route it takes on its delivery, again, there's no lease because the customer doesn't direct how the truck is used. So as you can see from just those top three steps, it can be quite complex in understanding whether your contract has a lease or not. So if your business has a lot of contracts like this and you need to step through this model, as auditors, we'd recommend that you document this process of how you actually conclude that there is a lease, because as Claire mentioned earlier, that documentation is key when your auditor comes in to have a look and see how you've landed where things contain a lease or not. So on the next slide, we see the impact of the new lease standard and some of the accounting considerations. So at a very high level, you end up with a right of use asset and a lease liability on your balance sheet. So you calculate the lease liability based on the present value of lease payments. And these payments include fixed and variable costs and any residual value guarantees. The right of use asset is typically calculated in the same way as the present value of the lease liability. However, you might have to factor in lease payments made at or before the commencement date, or any lease incentives or initial direct costs, anything like that. Your discount rates then, which you use to calculate your lease liability, there are three options there, and it can be very, very difficult to figure out what the interest rate implicit in the lease is. That's quite complex. And then for the incremental borrowing rate, you don't necessarily have all the information, and it can be quite hard to get that incremental borrowing rate. So FRS 102 and FRED 82 allows you the option of using the obtainable borrowing rate. So that's the rate of interest a lessee would have to pay to borrow over a similar term, an amount similar to the total undiscounted value of the lease payments. So it's the undiscounted value of the lease payments as opposed to the asset of similar value. So that's a real positive and something that should make transition to the new FRS 102 a lot easier. So on the next slide, just to talk about some recognition exemptions and practical expedience. So the one on the bottom left, the short term, is very similar to IFRS 16. So for any leases under 12 months in duration, anything under a year, all you do in this scenario is debit lease expense and credit cash or payables. So very straightforward. There's also a low value exemption, which is based on the asset value. And we've got an example on this in one of the following slides, which we'll talk through in a minute. There are a couple of practical expedients as well, where you can group leases of similar characteristics together in a portfolio. And there's also a practical expedient where you can elect not to separate non-lease components from lease components. And you can bundle them together when calculating your right of use asset and your lease liability. And that kind of comes up in one of our examples as well. So if we move on to the next slide. So this is an example of a low value lease. So company A leases office equipment for 5 years. The total value of the equipment when new is 3,000. So the asset value is important here when determining whether it is low value. Fred 82 doesn't explicitly give a monetary value for low value exemption. IFRS 16 explicitly states 5,000 euros is the threshold. But Fred 82, when it talks about low value, gives examples of the types of assets that are low value. So tablets, personal computers, office furniture, and phones. It also gives examples of assets that shouldn't be considered low value, like cars, vans, tractors, and land and buildings. And the new standard under FRS 102 does say that judgment is required, but I think practically it would be reasonable to assume that below 5,000 is low value. So in this example, we've determined the asset is low value. So we can see there are different payments. In year 1, it's 300, years 2 and 3, 400, and years 4 and 5, it's 500 per year. And there's also a lease incentive of 150. So very simply, you take all of your payments and your incentive, you add it up together, you get 1,950, and you divide it by the length of the lease, and ultimately you recognize a lease expense every year of 390 euros. So where possible, I'd be taking this low value exemption. Mention non-lease components as well. So it's another consideration when it comes to leases. And we mentioned earlier there's a practical expedient where you can include the non-lease components within or with the lease components. So, but if you don't take the practical expedient, then these non-lease components, such as services for maintenance or cleaning, these should be accounted for using other applicable standards in FRS 102. So this comes up in our next example where there's a non-lease component and we can account for it outside of the leasing standard. So what are the transition approaches then? So on 1 January 26, if you're applying FRS 102, you will have to transition into the new leasing standards. So you have those contracts that contain leases, and you'll have to take one of these approaches. So there are two options. So the modified retrospective approach. So this is where you transition over on 1 January 26. You don't restate your comparatives, and we give an example of this that we walk through on the next slide. The second option, if you just go back a second, sorry. The second option is where you apply a fully retrospectively. You apply the standard fully retrospectively and you restate your comparatives. And entities that we typically see choosing this option are probably subsidiaries of multinationals, where they might have been applying FRS 102, but they had a parent who was preparing financial statements under IFRS. So the lease accounting is already being performed in the background for group purposes. Therefore, for those companies, it'll be straightforward to implement a fully retrospective approach on transition for the company's FRS 102 financial statements. So we'll walk through an example. So this is an operating lease that needs to be brought on balance sheet. So company A leases an office property for a period starting on 1 January 2023 and a term end of February 2029. There's no option to extend the lease. The lease requires that there's a security deposit of 200,000. Rental payments are 12,000 per month in advance. When company A first entered the lease, it classified it as an operational lease. So just did the accounting we're all familiar with in terms of a lease. Its financial year end is 31 December 26, and they give us the incremental borrowing rate, which is very handy, and it's 1.88%. So it's from 1 January 26, it's transitioning to the new standard. So the 200K security deposit, that's a bit of a red herring. So that's a non-lease component, and we're not taking the practical expedient. So we just record this as a receivable on our balance sheet, and it doesn't impact our lease accounting at all. We're going to take a modified retrospective approach with this lease, so we won't be restating comparatives. What we need to do is calculate the present value of these. There are 73 instances of 12,000 euro lease payments. So the 73 monthly payments over the lifetime of the lease. So we calculate the present value of that using a discount rate of 1.88%. And that gives us the starting position at the commencement of the lease in 1 January 2023, as if we had been applying Fred 82 from that date. So we use Excel to calculate the present value of the lease payments on 1 January 2023. And that value is 839K. So in effect, if we had been applying new IFRS 102 from 1 January 2023, we would have recorded a right of use asset of 839k and a lease liability of 839k. Then from 1 January 23 right up until 31 December 2025, payments of 12,000 are made against the lease liability every month, but it's also accruing an interest charge, and also the right of use asset, which is at €839, that's being depreciated by 839 divided by 73 months, which is 11,340. So what happens is, and if we move on to the next slide, by the time we get to 1 January 2026, the right of use asset has gone from 839k and it's been depreciated down to 439.16, and your liability, which would have had 12k payments going against it, but also accruing interest, would be at 443,049. So to get this on balance sheet on the transition date, your first adjustment is to debit your right of use asset 430,916 and credit your lease liability 443,049. The difference in the balance goes straight into retained earnings. So 12,000 there debits retained earnings. You carry on from that point down on the 1st of January 2026, and you post your depreciation for the year, which is the same recurring amount every month. And then you also accrue your interest expense again against your lease liability and your payments that go in into your bank of 144k, and the lease liability is reduced by 137,000. And so there's like a big Excel goes behind that, and it explains how we get to that position. What we had done previously on the left-hand side is we debited retained earnings through our P&L, 432,036 payments, and credited our bank. So as you can see, there's a bit of change there in terms of how we have to transition over on 1 January 2026. Another key impact, and Brian touched on this earlier, is the impact on KPIs. And so you can see on this slide that in particular, like your EBITDA is going to increase, your interest expense is going to increase, total assets and particularly total liabilities are going to increase, and there's also impacts on your cash flow statement. So I think from your perspective and also from our perspective as auditors, is you need to consider, will this have an impact on your stakeholders? Have you got third-party lending? Are there covenants? Do you need to actually engage early with those stakeholders to actually point out that, well, this new standard is going to impact our financial statements, so do we need to talk about covenants? And so just some other factors to consider there. Then on the next slide, the final slide, so I kind of touched on some of these, but I think focus areas for us are when we come and look at and ideally, as Claire said, it would be at the interim period, when we come and look at your valuation, that we can see how you've decided whether contracts contain a lease or not, what your discount rate is, how you got to that, and we'd look at those valuations. But we also have to consider the new processes, the new systems, new controls. So documenting all of those and talking through those with your auditor as soon as possible, and early engagement, I think, is one of the key things that we need to consider. And then also the KPI point for me is one of the key ones as well. Will that impact any going concern assessments? Will there be knock-on effects for third-party stakeholders? So there's a lot to take on in leases. It's a big change, and if you do have leases in your business, it's going to be a big change on 1 January 26. So that's all for me on leasing, and I think I'm passing you back to Dim at this stage.
Yeah, thanks, John. And I think on that, like we are certainly finding the lease standard more challenging than revenue. I think, we've had a number of clients where we've supported in terms of getting the starting point correct, making sure the discount rate is correct, where is that kind of coming from, and actually doing some of the calculations. In particular, if you have a large volume of leases, this can get quite messy and complicated. So I think it is important to reach out on leases in particular if you are having a challenge around it.
Yeah, and I think the example, like, very conveniently gives us a discount rate of 1.88, but there's you could have a number of leases, and that discount rate could be different across all of them, and figuring that piece out is quite complicated.
Yeah, no, it is. Yeah. Thanks, John. So Dimna, you're going to just bring us, I think, through a bit of a whistle-stop tour, maybe, of some of the other kind of key amendments, because we are focusing very much on revenue and leases, but there are other, I think, changes that we need to be aware of. So if you want to just take us through some of those.
Yeah, so I suppose just briefly to mention some of the other key items. So if you are a Section 1A reporter of FRS 102 and you're a UK company, just be aware that some of the recommended disclosures are now mandatory disclosures. And I suppose this is to take some of the judgment out of what needs to be disclosed to get to that true and fair view. There is no change for Irish companies on this particular point, so just to be aware of that. There is also a change in the micro and small company thresholds. So that is effective for periods commencing on or after 6 April 2025. And the thresholds have increased for both turnover and balance sheet. However, there is no change to the employee thresholds. So just to be aware of that. And we might just move on to the next slide. Thank you. So I might just, I suppose, pull out a couple of points here, because it really is just making sure that you are covering off all of the critical things. And as you've mentioned, Brian, obviously revenue and leases is going to take up most of the time and the focus because those are the areas of the most significant changes. But just to bring up a couple of pieces, so from a fair value measurement perspective, if you are valuing different items, just be aware of the differences in definitions and also the changes in valuation techniques. If you are looking at financial instruments, so just to make you aware that there is an accounting policy election that's in current FRS 102, which permits you to use the recognition and measurement of Section 11 and 12, IS 39 or IFRS 9. There is a restriction now on taking the IS 39 as an option, and that is unless you already are doing so. So do be careful on that. And then even just, it's probably quite good to even group business combinations, share-based payments and income taxes together, because some of the critical pieces here really is that there was some gaps in FRS 102 on some of the topics that have now been clarified, leveraging the IFRS guidance that is currently there on these topics. So for example, for business combinations, sorry, we might just pop back to the last slide. Thank you. For business combinations, for example, there is additional guidance included in relation to the identification of the acquirer. And there is also guidance to support you in making that important distinction between contingent consideration and remuneration for ongoing services. Equally, as I mentioned earlier, from a share-based payment perspective, if you do have cash settled awards, there's some additional valuation guidance that you need to be careful on. And really helpfully, from an income tax perspective, there was a bit of a gap in the standard when it came to uncertain tax positions. There now is additional guidance that's coming over, which is based on IFRIC 23 and IFRS, which should support you with the decisions and the accounting for uncertain tax positions. A practical point I might mention, in particular, where there was a lack of specific guidance in FRS 102, entities may have made their own accounting policy, and that may not necessarily align to the new requirements that are coming into FRS 102. So do be careful on if you have taken policy elections, if these things are applicable to you, just to make sure that you are aligned effective 1 January 2026 for all of these items. And then I suppose finally, just to kind of wrap up on generally what we're seeing. So these really are quite significant changes for FRED 82. IFRS has more changes and more significant standards that are coming down the track as well. So I think it will be quite interesting to see what future changes the Financial Reporting Council will potentially bring out to create greater alignment between 102, even post FRED 82, and kind of moving that forward.
Simpson, thanks for that. There have been a few questions that have come through, so I might just take them one by one if that's okay. And Dimna, I am going to come back to you if that's okay, just on one or two questions. One is around bad debts, right? So it is an interesting question because it's obviously something that was originally debated in this version of the updates, and that is, do we expect to see the changes in around bad debts and credit losses?
Yeah, so this is specifically on the expected credit loss model that's in IFRS 9. So interestingly, this wasn't brought in with these amendments. My personal thought on it is there's probably enough significant changes without bringing in another kind of key judgmental piece, such as the expected credit loss model. But I do think this is something we need to be very careful to watch out for if the FRC is planning on making a change here, because that incorporation into the expected credit loss model of the forward-looking piece is really quite valuable when it comes to looking at the recoverability of certain financial assets. So I'd probably say it hasn't been brought in at the moment, but it's a watch this space to see what happens.
Yeah. And maybe the other question is probably just related and around that is, what other kind of changes are we expecting to see over the next kind of number of years?
So I suppose sadly I don't have a direct line to the FRC on all of the changes that they're planning on making, but I think based on what they've currently made in FRS 102, so they've covered off on revenue and leases.
Yeah.
The other big standards and changes that have happened from an IFRS perspective is financial instruments. There has been some amendments made to Section 11 and Section 12. Potentially there might be some additional changes there because there is quite a lot of differences between IFRS 9 and Section 11 and 12 currently. I know from an IFRS 17 perspective, that's a huge change. So I don't know if there's a potential that there might be a review of FRS 103. But I am very interested in seeing, I suppose, where IFRS 18, so the presentation of the financial statements, if there's anything coming from that standard that maybe might be considered from an FRS 102 perspective. But I suppose that's not quite clear at the moment.
Okay, thanks for that, Duncan. Claire, maybe back to yourself. And I suppose the question is probably centering around, the best way to kind of get your transition in progress. I know you touched on it, but I suppose if you were to kind of give people three or four, I suppose, guidance tips in around how to kind of start things off.
Yeah, so I think obviously getting the information hopefully from this webinar is obviously a good starting point, because I think there is a lot of information and etc. But I think it is to kind of have that high level understanding to actually start the approach to transition. So you won't have all the answers, but I think to have that initial understanding of what it takes will kind of get you started on the journey. And I think we touched on it kind of on both the lease and the revenue, but even the other sides, it really is to understand as well some of those practical expedients, some of the kind of exceptions, and even obviously the 105 as well, particularly that there's some specific nuances in there. So kind of understanding first high level, but then understanding obviously the exemptions, etc., so that you are kind of clear on where you may be able to use some of them to avoid kind of some of the further work down the line. And then I think in particular, then it really is around kind of getting the time to make sure you're looking at this early, so that you can have that understanding up front, because I think it could go on, and if you're under pressure, depending on what your complications might be, it could be quite hard to turn around quickly. And then I think really around, I think we said some of it will need maybe a bit of additional work around, have you got all those contracts in place, whether it's revenue, whether it's lease, etc., that when you actually do go to look at it, you might go on this call and go, I think this will be fine. But actually, when you go in to look at your contracts, whether it's leases or revenue, it might mean that you don't have all in place that you thought you had. So there may be a bit of working in kind of getting that kind of cleaned up so that you can actually work your way through the steps and then obviously ultimately get to your kind of have you in adjustments or not, or in the lease case, obviously what your adjustment is going to be. So I think it is. And as I said, I think it's reaching out as well, in particular for those where there is some kind of unusual, there's nuances, obviously we've talked through some kind of quite simple examples, but ultimately if you're kind of outside the box on those, to really kind of reach out to the people to understand if there is any other kind of guidance and help you need to make sure you can kind of do that transition as smooth as possible.
It's black there. John, probably a similar kind of question kind of coming through from a lease perspective. So to really, I mean, there's I think quite a number of people who haven't really started anything on this. So I suppose some kind of practical guidance on where they might start.
I think the first thing to do, well, is probably go back on this webinar and maybe do a small bit of research and a small bit of consideration. But I think the key point is, again, and Claire touched on it already, is around your contracts. And so it's actually understanding what kind of contracts do I have out there? Do I have contracts? And which you touched on, Brian. So there might have been stuff that's been rolling on for years that it's very hard to understand. So getting those contracts and putting them in place and actually and documenting them and documenting, like, I don't know if there's anything nuanced, if there's I know when you get to servers and use of servers and things like that, that can get quite complicated. So actually documentation of what you have, because the old operating lease model is now gone in effect, unless you've got low value ones or short term. But actually getting that documentation, doing that review, reading through the documents when you have them, and understanding how is this going to impact my business. I think that's the key for a starting point.
Dimna, maybe back to yourself. Like there are a number of practical expedients. And I suppose the question is probably, should companies kind of stay close to IFRS as possible, as close to IFRS as possible, or kind of go with the more simplified options?
I suppose that really depends on your business. You do run the risk of if you take too many simplifications and you're within an IFRS group, you're actually creating more work for yourself when it comes to consolidation. But obviously, maybe if you don't have that need to consolidate, going for the most straightforward approach possible is always the best way to go, and to think about how much reoccurring work do I need to do. So it's probably very specific to, have a think about do I need to consolidate? Do I need to align more to IFRS? Will taking these simplifications actually create more gap differences? Or is there a possibility for me to reduce the reoccurring work I need to do every year on this particular topic?
Yeah, okay. And then this was another one for yourself, just in around, I suppose, are there any other helpful resources out there that can kind of help people? I mean, both John and Claire referenced, obviously, the webinar is a touch point, a starting point, but is there other kind of resources, I suppose, that people can kind of potentially use?
Yeah, so the Financial Reporting Council has issued a number of fact sheets, which are really excellent and useful documents. I'd in particular call out the one on transition. It's a really clear, easy to follow document. Deloitte also does have some need to knows on FRED 82 as well, which can be a useful reference too. But the fact sheets in particular are very helpful.
Right, no, thanks for that. Garrett, could it potentially just a question that's kind of coming through on this, and I know you don't have a crystal ball, but the expectations around, I suppose, CSRD and the regulation, I suppose, as we kind of know it, and likelihood for something down the lines for private companies. What's your thoughts on what you're kind of hearing and seeing at the moment?
Yeah, it's an interesting one, Brian. Certainly, it's difficult in the context of this move to simplification, reduced regulation. Certainly, as part of the proposals, there's discussion around some bringing through a voluntary reporting framework for those companies that are large but sit below that threshold. We're still waiting to see what shape that's going to take. There is an existing SME framework out there, but it's the discussion is around not that being used, but something else. So, like I think for companies in this call that have fallen out of scope, as I said before, it's a case that sustainability is not going to go away. There may well be a lightened form of reporting down the track, and that may be on a voluntary basis, although there may be some other form of mandatory requirement. At this stage, it's very unclear. I think, it's not going to come through for a number of years, but I think it doesn't take away the need for companies more widely to consider sustainability impact, and then what they're doing internally, how they're managing it internally, and the sort of KPIs that they need to develop, whether that's from a reporting perspective or just to manage what they're trying to do internally and the targets that they set for themselves.
Yeah, no, thanks for that, Garrett. Yeah, that makes sense. And just doing a check just to see if there are any other questions there in the text. If there is anything that we haven't managed to answer, we will do our best. We'll come back to people individually as well. So I think maybe at this point then I might just wrap things up. We're kind of coming up to 10 to and there's probably kind of, I think, four maybe kind of key kind of points if I was to kind of summarize things up for everybody on the call. I mean, the first, while sustainability reporting as we did know it has certainly gone away. I think there are still elements of, I suppose, what we may have learnt during that discussion around sustainability and ESG. And I think there's definitely components of that we will see companies being keen and interested to kind of continue to look at. And we are still seeing, I suppose, the funders asking questions around this kind of space, so it hasn't fully kind of gone away. So I think it still needs to be on the minds, but I mean certainly reporting is certainly gone away for the moment. I think when it comes to then FRS 102, I think it is kind of important that I think everyone is talking about leases and revenue, which are the two key changes. But I think it is important for your own business to just ensure that you have gone through all the changes. There are a number of, I think, very good, as you'd referenced earlier, Dimpna, kind of resources that you can use there to kind of look at the key changes, the key kind of differences, to make sure that there's nothing missed from your own kind of business perspective that's specific to your business. And certainly reach out if you are having particular challenges in any of those kind of areas. We're more than happy to kind of be able to support on those. I think then when it comes to kind of revenue, I mean, the starting point is the contracts, and we are certainly seeing across the board challenges in that regard. So I think your starting and stepping point has to be to have the contracts in place, and to start working your way through that kind of 5-step model. And again, kind of reaching out on that if you are kind of unsure, if you're not clear in terms of kind of where you need to go. And I think kind of finally on leases, that's certainly we are kind of seeing, I think, is the bigger challenge. Certainly, if you have more than kind of 5 to 10 kind of leases, lots of different interest rates, sometimes actually a challenge around what that interest rate and discount rate should therefore be. So again, if support is kind of needed, evaluation kind of support is needed around those, again, please feel to kind of reach out in that regard. Hope you found it useful. Thank you very much to all the panelists for your contributions today. And if you do have any kind of questions, please do reach out to us. We will also have a follow-on a kind of mail from this webinar. And we will close it out now. Thank you.